stock market is becoming dangerously concentrated at the top. There are just 7 companies that have grown so much, they make up a third of the entire S&P 500 and are responsible for a majority of the gains over the last 2 years. At this point, are they all just ridiculously overvalued? Do we have a stock market concentration bubble that's about to pop? Grab a drink, take a seat, let's talk about it. What's up, y'all? It's Brian. I did a valuation analysis on the Magnificent Seven using the discounted future cash flow method to see if any of these companies are worth it to buy right now. More importantly, which one is the best value at this time. Currently, there is 2.36 trillion USD in circulation. As a whole, the Magnificent Seven is worth $18 trillion. You couldn't even buy Apple, NVIDIA, Microsoft, Google, or Amazon individually if you had all the dollars. That's how grossly massive these companies have gotten. So how does somebody even begin to determine what is the fair value of this entire company? And how does that translate to share price? Well, let's take Apple. If Apple is worth $3.5 trillion, I would take 15 billion shares, multiply it by their share price, and that would give me their market cap, which is $3.5 trillion. So I am looking at share price, how it relates to the total value of the company. And the way I'm trying to value the total company is by looking at their free cash flow and how it's projected that they're going to grow that free cash flow in the future. So what is free cash flow? Free cash flow is the amount of cash that a company has left over at the end of the year after they've paid all their expenses. And this is the chunk of cash that they're going to use to pay off debt, to grow their company, or pay out dividends to shareholders. Basically, it's the chunk of money that I care about that's bringing me value as a shareholder. If they're using it to pay off their debt, then they're going to be reducing their interest payments, which means they'll be able to make more free cash flow next year. If they're growing their company, then they'll get more revenue, presumably, which will grow their free cash flow. And if they're paying out dividends, that is where I physically get my money. I get my return from stock either through a dividend or through the share price going up. So that's why I care about free cash flow. I think it's better than earnings or net income because net income can be reduced by non-cash expenses, things like depreciation. If a company buys a lot of properties and equipment, they may use that equipment for 30 years, but they're going to depreciate its value. So on paper, they're losing cash from that depreciation, but they're not actually losing cash. That's why I like to focus on the free cash flow. I made another video that goes into greater detail, so consider checking that out if you're interested in a deeper dive. Not only do I care about the current free cash flow, also need to project the future free cash flow. And one thing I like to keep in mind when I'm trying to do that is, where is this company on the business life cycle? At the beginning, when a company is launching, it's common for them to have negative profit and negative cash flow, and they are running their business off of debt until they can confirm that their product is going to work in the market. And then they hit their growth period if they can confirm that their product works. And when they are under their growth trajectory, they start to have positive profits and positive free cash flow until they're starting to reach their peak, which is called the shakeout period. This is where they're getting close to reaching market saturation. Maybe more competition is coming in, and this is where their sales will peak. And then after that, they hit maturity, where revenues might start to go down, profits might start to go down a little bit, but they're able to achieve maximum efficiency at this stage, so they can still continue to generate more and more free cash flow and pay that money out to shareholders through a dividend most commonly. And then finally, a company hits its decline. Now, just because a company is declining at a given time, it doesn't mean they're locked into decline forever. They can still reinvent their business. They can release a new product, acquire another company to change how they do their business, and maybe enter a new growth cycle. So with the Magnificent Seven, a few of these companies are trying to achieve that second spurt of growth. A couple of them already have. So that's an important metric that I'm going to be looking at. And this also will affect how risky a given company is. If a company is trying to grow, that means they're putting a lot of their cash into that growth. And if it doesn't pan out, then that's money that didn't go to shareholders. So as a company is trying to grow, their risk is going up. As a company is reaching maturity, their risk goes down significantly because they're very predictable at that point. They are just increasing their efficiency, trying to increase their free cash flow. And typically, a mature company will start to pay out a dividend to shareholders and return that value in a very concrete way. So when I'm trying to determine where a company is on this business life cycle, there are 7 metrics that I like to look at to give me clues as to where they are. So first, I like to look at revenue. Is their total sales increasing a lot year over year, or are they starting to level off? That's going to give me a hint as to whether they're growing or in their shakeout / maturity phase. I like to look at their research and development. If R&D is a significant portion of their revenue and it's increasing by a lot every year, that's signaling to me that this company is trying to grow. In the end, a company is going to do what is best for its owners. If cash is spent on research and development, if they think that's going to grow their company, they're going to do that. If they don't think research and development is going to benefit the company's share value, then it's much better to just return that cash straight to shareholders in the form of a dividend or a share buyback. So if R&D is increasing and it's a big chunk, that signals to me growth. Same goes for capital expenditures. If a company is spending a lot of money on buying new land, putting up new buildings, increasing their infrastructure, this tells me that they have more markets that they need to expand into and that they are still potentially on a growth trajectory. I also like to look at cash acquisitions. If a company is buying up other companies, that tells me maybe they're trying to pivot or they have more areas that they could grow into. They can eat up a competitor. Share repurchases and dividends. If a company is buying back a lot of their shares or paying out a lot of cash to shareholders in the form of a dividend, that signals to me that they don't have growth on their mind. They'd rather just put that money back in the shareholders' pockets. And finally, I like to look at the guidance that the company gives on its quarterly reports and its annual reports. And then, of course, what do the professional analysts say about the company's future prospects? Those are the 7 things that I like to look at. So let's start at the top. For Apple, their revenue is slowing the last few years. Their research and development is 8% of their revenue, which is moderate, and it's slowly going up. However, their capital expenditures is relatively small. It's only 2% of their total revenue, and it has been flat. They're not spending any cash to acquire companies. They have been doing consistent buybacks, and they have a small dividend. And on their quarterly reports, I don't see much reference to how they're planning to grow and expand their market. The analysts say that there's really just moderate growth on the horizon. So I'm putting Apple in the mature company category. And that's going to inform me how much I can reasonably expect their free cash flow to grow in the future. So let's go straight into Apple's free cash flow analysis. So here on my spreadsheet, once I type in the ticker, it automatically fills out all the information for me. It's pretty handy. And then in these yellow cells here, I do a few tweaks. So the way this spreadsheet works is it gives me 5 different projections for what the fair share price is to buy Apple today. If their revenue continues to grow at the same rate that it has been, then $170 would be a fair share price today. Now, Apple's current share price is $230 per share. So for me to buy them, they would need to grow faster than what they have been over the past 5 years. My projection, this is where I put in the growth that it would take for Apple's share price to be fair today. So I put in myself, and I just pull these numbers out of thin air. This is just what it would take for them to meet a fair share price. They need to increase their revenue over the next 5 years by 14%. Then the 5 years after that, they would need to increase their revenue by 7% every year. And then they hit their perpetual growth rate, which is just flat line of 3% growth year over year. So if they can achieve that, then today their fair share price would be $227. So what do the analysts think that they're going to do? Well, the lowest analyst projections put this green curve right there. If their revenue starts to dip off a little bit and then it increases by 7% and 3%, then their fair share price today would be about $114. If the average analyst projection is correct, which is this yellow line, then the fair share price would be $170, which is still, like, Apple is still very overpriced according to the average analyst. And then finally, the highest analyst projections. If Apple is able to grow their revenue by 15%, 19%, 21, 12, 10, and then for the next 5 years, 7%, and then the next years after that, 3%, then their fair share price is $245. If that were the case, Apple is only a little bit undervalued in the most best case scenario. So for me, as a mature company, Apple is not valued low enough for me to buy them at this price. I would need to see Apple share price drop close to $170 before I would consider buying Apple. The second biggest company in the world is NVIDIA, or at least in the S&P 500. Their revenue has been growing rapidly lately. The growth of AI has been very good for NVIDIA, and their data center revenue, that's been the majority of their growth. Their R&D is 10% of their total revenue, and they have 4 times their R&D expense since 2020. So they are trying to grow for sure. Their capital expenditures is a smaller percentage of their revenue, but it has tripled since 2020. They have consistently acquired companies, but a very small percentage of their revenue, less than 1%. There has been very minimal share buybacks. And as far as their dividend goes, they have an incredibly small dividend, 0.03%. So that's virtually zero dividend. Lots of references to growth on their annual and quarterly reports. And of course, the analysts also agree that they think NVIDIA is going to grow. So the question now is, how much growth is it going to take to justify their current share price, which is $137 per share? So according to the future free cash flow analysis, NVIDIA's past free cash flow margin, that is the percentage of their revenue, which has been free cash flow, is 34%. And I guess I should also say for Apple, their free cash flow margin was 27%. In both cases, I am boosting their free cash flow margin by 1%. That is this number right here. So for NVIDIA as well, I am boosting their free cash flow by 1%. And that's because I give these companies a little bit of credit for their capital expenditures and their research and development. Typically, these two numbers actually take away 100% from the free cash flow. But if a company is spending a lot of money on its growth, then I will give some of that money back into the free cash flow and boost their free cash flow a little bit. I think it's more accurate because if the company is really going to be using that money to grow their free cash flow, then I would want to count at least a portion of it in that calculation. So for NVIDIA, the way I came to that conclusion is I looked up how much is their research and development growing, what percentage of their R&D are they using as a percentage of their revenue. Same goes for capital expenditures. And since both of these are increasing so much and it's a relatively high percentage of their revenue, I'm giving them credit for a third of their R&D expense and a third of their capital expenditures. If NVIDIA decided that it wanted to just be a mature company, they could cut their R&D by a third and it would not impact their operations today in a meaningful way. After adjusting their cash flows in that way, I have determined that I can give them an extra percentage point on their free cash flow margin. With that in mind, if NVIDIA is able to repeat their past revenue growth, which is 41%, and then they continue the next 5 years after that to have 15% revenue growth, and then reach maturity at 10 years out and grow at just 3%, which is equal to inflation, then the fair share price today would be $159 per share. And they are currently trading at 137. So if they're able to meet their past growth trajectory, then now's a good time to buy. The question is, will they be able to do that? Clearly, they are on a growth trajectory. So how close are they to leveling out into that shakeout period? That makes all the difference. So what is the precise growth that I would need NVIDIA to beat to feel confident investing in them today? I would need to see 35% revenue growth over the next 5 years, followed by 15% revenue growth after that. And I would put them at a fair share price today. I don't know that that's too much to ask for if everything goes right for NVIDIA. The average analyst projection puts NVIDIA right at $137 per share, which is great because that's what they're at. And then the highest analyst projections put a fair share price today at $387. That means that in 2025, they're saying they're going to grow their revenue by 130%. In 2026, they're going to grow their revenue by 114%. And then in 2027 by 80%. So this is a really great future for NVIDIA. If it's able to happen, then NVIDIA is a great buy right now. However, I think there is a lot of risk associated with NVIDIA. Remember the growth curve that we showed for a company? When a company is trying to grow, that is when their risk is the highest. That goes for NVIDIA right now. I made a whole video about it. You'll have to check that out if you're interested to see why I think NVIDIA is too risky. Anyway, let's move on to the next company. The third biggest company is Microsoft. Their revenue growth has been consistent, about 15% year over year for the last 5 years. Their R&D is 12% of their total revenue, which is pretty big. It's been growing moderately. Capital expenditures is 20% of their total revenue, and they have tripled that since 2020. So they are expanding a lot in terms of infrastructure and equipment and buildings and land. So they are consistently making cash acquisitions. They have minimal share buyback. They have a minimal dividend. And of course, in their quarterly report, they are referencing growth moderately, and the analysts are also projecting moderate growth. I'm putting Microsoft at the tail end of the growth phase, maybe getting close to maturity, as they are still spending a lot of money on growth. If Microsoft is able to grow with their past revenue growth, that would be over the last 5 years, they've grown their revenue by 11.5%. If they then grow at 8% over the 5 years after that, and then 3%, then a fair share price for Microsoft would be $350. And their current share price is $429. So they're going to have to do better than they've done in the past. I would need to see 16% revenue growth over the next 5 years, followed by 8% for the 5 years after that. And then I would be comfortable buying Microsoft at today's share price. So how likely is that? According to the analysts, the lowest analyst projections and the average revenue projections would say no, it's unlikely. The average analyst projection shows 15% growth, followed by 14, 14, 14, 13, 11. So not quite maintaining 16% growth over the next 5 years, according to the analysts. So for me, Microsoft is a little bit risky. It's not quite a home run. I don't know about y'all, but I need a brain break. So Lily is going to help me out with that. If she'll hang around, maybe not. I will have a sip of whiskey though. I don't know if y'all are big whiskey connoisseurs. This is my bourbon of choice today. This is barrel bourbon, Texas Dawn, finished in ruby port casks. So pretty good, but pretty strong. I can only take a small sip. This is 125.8 proof. So what is that? 62.9% alcohol, something like that. Super strong. Okay, moving on. The next company I want to look at is Google. Google has had consistent revenue growth of about 15%, so similar to Microsoft. Their R&D is 14% of their total revenue. It's been growing moderately. Capital expenditures, 14%. It's doubled since 2020. Consistent cash acquisitions, consistent share buybacks, but pretty small. So that's a little bit mixed signals. They are showing some growth, some talk about growth in quarterly reports. And of course, the analysts as well are hinting at moderate growth. Google to me seems to be in a similar position on the growth trajectory as Microsoft. So let's see, does it look like it's a better deal than Microsoft? According to their past performance, which is for the last 5 years, they've hit 13.5% year-over-year revenue growth. If they're able to continue that pace and hit 5% revenue growth for the next 5 years after that, then their fair share price today would be $262, which looks pretty dang good because their current share price is $197. So according to past performance, I'm liking it. The minimum revenue that I would want to see to buy Google today would be a future revenue growth over the next 5 years of 8%, followed by 5% revenue growth for the 5 years after that. And then of course, going into infinity with the perpetual growth rate of 3%, which is just equal to inflation. To me, that sounds incredibly reasonable to expect just 8% revenue growth out of Google, who's spending lots of money on research and development, lots of money on capital expenditures. And the analysts, the average analyst projections are showing 17% growth in 2024, 11 in 2025, 10 in 2026. This company looks like it is perfectly reasonable that it could grow at a rate of 8% revenue for the next 5 years. So Google to me is looking like a great purchase. Now, one note that I would point out is their past free cash flow margin has been 21.5%, and I am adding 8% to that margin, which is pretty high, which means I'm boosting their free cash flow margin to about 29, 30%. So let's turn to their financials. For Google, their research and development has been increasing rapidly. Their capital expenditures have been increasing rapidly, and they have consistent cash acquisitions. Their construction in progress has been $46 billion over the last 12 months, $35 billion previously. Their total property, plant, and equipment has increased dramatically every single year. They're spending a lot of money on growth, so I want to give them some credit for that cash spent on research and development, on capital expenditures. And since Google appears to be on a growth trajectory, maybe at the tail end of the growth, I'm going to give them a third of their research and development back as credit, meaning I think they could drop off their R&D by a third and not be impacted in their current business. And I'm giving them a quarter of their capital expenditures back as free cash flow. The result of that change is boosting their free cash flow margin to about 30%. So for me, Google is looking like a great purchase right now if I was going to buy one of the Magnificent Seven. But let's see if any of the remaining companies can top it. Next up, let's check out Meta. Meta has had consistent revenue growth of 20% on average over the last 5 years. That is pretty big, second best to NVIDIA. They spend a huge chunk of money on R&D and capital expenditures. 28% of their total revenue goes into R&D, and that expense has doubled since 2020. 20% of their revenue goes into CapEx, and that has doubled since 2020. They have had consistent cash acquisitions, minimal share buyback, minimal dividend, 0.33%. They do reference growth in their annual reports, and of course, the analysts as well are expecting them to grow. So this company, to me, based on their spending and their revenue growth, they are on a growth trajectory, or at least they're trying to be. So what kind of free cash flow growth do they actually need to justify their current share price, which is $612 per share? If they are able to grow at the same rate that they have over the past 5 years, which is an annualized average growth of 13.8%, then their current share price today should be $799 per share. If they're able to grow at the same rate as the past, then they are in a great spot currently to buy. So what's the minimum amount of growth I would need to see? I would need to see just 8% growth over the next 5 years, 5% growth the 5 years after that, and then 3%. The same growth trajectory as Google, I would need to see for Meta to justify their share price. So these two companies are neck and neck. They're both looking really good. Now, if we look at the average analyst projections for Meta, they're saying 23% in 2024, 15% in 2025, 12% in 2026, 10%, 9%. They're showing really good revenue growth. So the average analyst projection is in line with Meta being a great purchase right now. Once again, one caveat is I am boosting Meta's free cash flow margin by 12%. Just like with Google, I'm giving them credit for 33% of their R&D cost. I'm saying they could cut their R&D by a third and be okay. And I'm giving them credit for a quarter of their capital expenditures. Now, Meta is a little more capital intensive, so that's going to result in a bigger boost to their free cash flow margin. So that is a little bit of a risk, but the average analyst projections put their share price at $810. So even though Meta has gone up quite a bit lately, they are on a growth trajectory, and their fair share price, according to free cash flow, demonstrates that. Next up is Amazon. Amazon has consistently grown their revenue on average 10% over the last 5 years. Their R&D is a pretty big chunk, 14% of their total revenue, and it's doubled since 2020. Their capital expenditures is just growing slowly, and it's 11% of their total revenue. They've had consistent cash acquisitions, less than 1% of their total revenue. They're issuing shares, which is a little bit surprising to me. I would expect for them to be performing share buybacks, have little reference to how they plan to grow on their previous quarterly report, and analysts are just showing moderate growth prospects for Amazon. So just one small correction for the past revenue, I gave them credit for 10%, but over the last 5 years, they've actually averaged 15%, because if you look at their revenue, they had a big revenue spike during COVID, and since then, it's come back down to more normal levels. So I'm saying that their past revenue really has been about 10% for the last 3 years, but if we're going back 5 years, their average revenue increase has been closer to 15. So if they're able to continue a 15% revenue growth, that would put their fair share price today at $194. However, they're actually trading at $225. So they're going to have to do better than their average growth from the last 5 years, which included COVID growth. For me, this looks a little bit difficult. So what kind of growth would they need? I would need to see 20% growth every year for the next 5 years, followed by 12% growth for the 5 years after that, and then 3% growth. And that would put their fair share price at about $235. The analysts do not think that's going to happen. Even the highest analyst projection puts their fair share price at $228 today. So if I look at the highest analysts, they're looking at 20% growth for 2024, 17, and then 19, and then 18, and then 19. So they're showing a little bit less than 20%. That's the best case scenario. If Amazon looks like it's a little bit overvalued, I would want to see that share price drop to closer to $160, $150 per share before I bought Amazon. Last, we have Tesla. Revenue has been actually slowing for Tesla the last few years. Their R&D is about 4% of their total revenue, but it has tripled since 2020. So they are growing their R&D quite a bit. Their capital expenditures is about 11%, and it's tripled since 2020. Car manufacturers are pretty capital intensive, so I would expect to see Tesla spending a lot of money on their capital expenditures. They have minimal cash acquisitions. They are issuing shares, and they are talking about growth plans all over the place in their quarterly reports. The analysts also think that Tesla is trying to grow. So Tesla is in a high growth possibility phase, but it's also incredibly risky. And we have seen that their revenue has not been growing like you would want to see with a major growth company. On my spreadsheet, I've calculated Tesla's average annualized revenue growth over the past 5 years to be 31.5%, which is really good. But if I actually go into their financials and look at how it's been increasing, in 2020, they increased it by 28%, 2021 by 70%, 2022 by 50%. But then the last 2 years, it's been 18%. And then now the trailing 12 months, they've only increased their revenue by 1%. So the revenue has been slowing down quite a bit lately. But if they're able to turn that around completely and they're able to gain 31.5% revenue increase over the next 5 years, followed by 20% revenue growth the 5 years after that, then according to their past performance, their current share price should be about $305, but they're currently trading at $426. They're going to have to significantly outperform their past performance for their current share price to be a fair share price. So I need to see 40% revenue growth over the next 5 years, every year, followed by 20% revenue growth year over year, and then hit maturity at 3% growth for me to buy their share price at $413 per share. The analysts don't think that's going to happen on average. The lowest projections put them at a $37 share price. The average projections put them at $161. Their current share price is $426. If the best case scenario happens, their fair share price should be $468. That's really only a 10% discount in the best case scenario. So in my mind, Tesla is way overpriced, and that is with giving them a 5% boost to their past free cash flow margin, which has averaged 6.5%. So that puts their future free cash flow margin at about 11.5. And if I go back into their financials, I've never seen them reach 11% on their free cash flow. It's been 9, but then the last 2 years, it's been 4.5% and 3.72%. So for me, if I had to pick one of these companies to invest in, it would be Google, followed closely by Meta. And I picked Google over Meta because I gave them a smaller boost to their free cash flow margin, and Meta is putting significantly more cash into their capital expenditures and their research and development, which represents a greater risk. If those investments aren't going to pan out for Meta, then that would represent a greater chunk of free cash flow that was wasted as opposed to Google. And finally, the wild card pick out of these is definitely NVIDIA. They have some insane growth prospects in their future. However, they also have some pretty big risks associated with their business model. If you want to see more information on that in greater detail, check out this video right here. Cheers. Oh, man, that is strong, but it's good.